Welcome to the deep dive. Today, we're opening the books on one of the really big names in Buy Now, Pay Later. We've got their latest financial review right here, the FQ126 report. And honestly, it details a financial pivot that's, well, it's pretty fascinating.
It really is. And look, this stuff is dense, no doubt about it. But our goal for you listening in is pretty straightforward. We want you to grasp the financial engineering behind how this massive company is operating now, specifically how they're tweaking their product mix, optimizing operations, and really kind of reinventing their funding structure to drive this huge jump in profitability.
Yeah, and when we say dramatic profitability, we mean a massive change. Let's hit the headlines first, because the growth story, still roaring. Total revenue jumped 34% year over year, hit $933 million. And the gross merchandise volume, GMV, that shot up too, went from $7.6 billion, same time last year, to $10.8 billion this quarter. Huge numbers.
The GMV growth is definitely impressive, yeah. But the real story, I think, is at the bottom line. They swung from an operating loss, and it was a big one, $133 million in FQ1 last year, to actual operating income of $64 million this quarter. I mean, that's a $196 million improvement in just 1 year. And if you look at their adjusted operating income number, it's even sharper, basically doubled, up 104% to $264 million.
Wow, okay. That sounds like a company that suddenly got very serious about efficiency. Okay, let's unpack this. Because if you look just a little closer at those booming top-line figures, you hit this kind of curious thing. We're calling it the revenue paradox for this quarter.
Right. And that's the first big question we need to tackle for you. Despite revenue growing 34%, despite GMV soaring, total revenue as a percentage of that GMV actually went down, yet fell 52 basis points, from 9.2% down to 8.7%. So if things are going so well overall, why are they making, slightly less revenue for every dollar of stuff sold through their platform?
That is really counterintuitive, isn't it? Usually, a drop in your percentage yield like that might signal, I don't know, weakness, maybe desperation.
Yeah.
But here, it really looks like a strategic choice. My read of these sources is that they're deliberately trading some of that marginal interest income for high volume fee revenue and just much better capital efficiency. It feels like they're changing from a lender that holds onto debt into more of a capital machine that just sells product and collects fees along the way.
That's exactly the insight, I think. This dip in the percentage wasn't some accident. It was driven by very conscious changes across their four main revenue streams, and specifically how they're choosing to make money off the loans they originate.
Okay, let's break those streams down then. First up, network revenue. Grew 38%, pretty much kept pace with GMV, right? But it did decline slightly as a percentage. So why that small lag?
Two main things happening there, both tied to sort of consumer choice and the product mix. First, you saw a real shift towards direct-to-consumer volume, D2C. And that D2C volume, it just tends to have a lower network revenue percentage attached than the integrated checkout stuff they do with their big retail partners. Second thing, the average term length, the duration of their 0% APR monthly installment loans, it dropped by about 6%. And since network revenue for those zero-interest loans is tied directly to the loan duration, well, a shorter loan just means a lower revenue percentage compared to the GMV.
Okay, so consumers are picking faster, cheaper loan options, drives massive volume, like you said, but just slightly lowers that percentage take rate. Makes sense. Now, what about interest income? That grew 20% because the average loans they actually held on to increased by 19%. But interest income as a percent of GMV dropped significantly, like 74 basis points down. What's the story there?
Simple. They're keeping less of the interest-generating paper themselves. The sources are clear they sold a higher percentage of their originated loans relative to GMV this quarter. They kept less on the balance sheet. That's the strategic pivot you mentioned right there in action. And also, don't forget the mix shift. That increase in 0% APR loans, from 25% up to 28% of the total volume, that naturally pulls down the average interest yield on the portfolio they do decide to keep.
Right, which perfectly sets up the real engine of the quarter. Gain on sales of loans. This seems to be where the magic happened. This revenue stream grew, a massive 87%, and it increased its contribution to GMV by 27 basis points. I mean, this has to be the payoff for selling off all that paper. It absolutely is. It shows those big strategic partnerships, like with Sixth Street and others, are really firing on all cylinders now. That 87% growth, driven by a 76% increase in the volume of loans they actually sold. But it wasn't just volume. They also got better pricing. The actual gain on sale as a percentage of the loans sold, that ticked up too by 14 basis points. So they sold more and got a slightly better price for each loan they offloaded.
Nice. And then the final piece is servicing income, up 53%. This feels like the icing on the cake, doesn't it? They sell the loan, book an immediate profit, and still get to collect a fee for managing it for the buyer.
Exactly. That servicing income is directly tied to the growth of their off-balance sheet platform portfolio the loans managed for partners. That portfolio grew by about 60%, right in the line. So the core strategy is pretty clear now, isn't it? Use those popular low-yield products like 0% APR to grab market share in huge volume, and then immediately turn around and monetize that volume by selling the assets off efficiently, locking in a nice gain, plus getting that recurring servicing fee stream.
It really is an efficient machine. It's built around turning capital over quickly, not just sitting on assets and collecting interest slowly.
Precisely. They're using their brand power to originate the volume and then using their funding partnerships to efficiently move it off their books.
Okay, let's shift gears a bit. Let's look at the product mix and the cost side, because volume alone doesn't explain a nearly $200 million profit swing. The uptake on those low-interest products is just undeniable, right? 0% APR monthly installment GMV was up 74%. Pay and X volume, those really short-term 0% loans, up 55%.
Yeah, the mix is definitely shifting. Right now, it's about 72% interest-bearing, 13% is that 0% APR monthly type, and 15% is the short pay and X stuff. One detail, though, that kind of jumped out at me from the source material, even with that big shift towards 0% APR, the network revenue as a percentage of GMV for those specific 0% APR monthly loans, it actually held stable. That's after you adjust for the shorter loan durations we talked about. It suggests the pricing deals they have with the merchants are holding up pretty well, even while the consumer gets a faster, cheaper payoff.
Interesting. Okay, now let's talk about the key efficiency metric, RLTC. Revenue less transaction costs. This is basically their gross profit margin before overhead, right? RLTC grew 60% to $455 million. That's huge. But it actually exceeded their own long-term target range, came in at 4.2% versus a target of 3% to 4%.
Yeah, that RLTC performance was phenomenal, and it's what really counteracted that drop in the overall revenue percentage we discussed earlier. It was powered mainly by two really big improvements, two tailwinds. First, a 59 basis point improvement in their provision for credit losses. Basically, they had to set aside less money for expected defaults. That's a direct boost. Second, this is huge, a 35 basis point improvement in funding costs. Just cheaper to borrow the money they need.
That decline in funding costs feels like a major engine for this whole strategy working, doesn't it? Their average funding costs dropped by almost a full percentage point, 98 basis points year over year, down to 6.7%. And the sources say this reflects, really good execution in the ABS market, the asset-backed securities market, and getting better rates on their warehouse lending facilities.
Absolutely.
Yeah.
When your cost of capital drops that much, the profitability of literally every single transaction improves. Even if the upfront revenue percentage is slightly lower, it makes the whole model hum.
Okay, so let's circle back to that massive $196 million improvement in operating income overall. How much of that was genuine, ongoing operational gains versus maybe some strategic financial timing or accounting things? Because $196 million, that's a game-changing amount of cash flow improvement. It must have totally flipped the script on their viability narrative.
Right. Let's break it down. About $170 million of that $196 million improvement came directly from those RLTC gains we just talked, to better funding, lower credit losses, solid operational stuff.
Yeah.
About $26 million came from a 6% drop in operating expenses, excluding the transaction costs. Now, for a company growing GMV at over 40%, seeing OPEX actually fall is, it's unusual. You have to dig into that.
Yeah, I saw that buried deep in the notes too, that OPEX decline, driven almost entirely by sales and marketing costs falling 46%, like a $67 million drop. But then you dig into why S&M dropped, and you find this very specific accounting item. Can you explain that $72 million decline in something called enterprise warrant expense?
Yes, this is basically an accounting cleanup story as important context. Essentially, the company had these outstanding promises of equity called enterprise warrants linked to some big early partnerships. Think of it like deferred compensation tied to those deals. Over time, the expense associated with those warrants gets spread out or amortized on the income statement. The key thing is, specific chunks, or tranches, of those warrants finish their amortization period back in FQ2 of last fiscal year, FY25.
So they basically just finished paying off an old accounting expense from past deals.
Exactly. That large non-cash accounting charge, the $72 million, was still hitting the profit and loss statement in the comparison quarter last year. But it just vanished this quarter because the amortization was complete. So that gave them a huge but ultimately non-operational boost to the recorded operating income this time around.
Okay, so if I'm hearing you right, a decent slice of that impressive $196 million profit swing was actually a timing thing, a legacy financial obligation that just rolled off the books. And if you strip out that one-time warrant effect, sales and marketing costs were actually up 24%, which makes more sense given the growth, probably due to rising co-marketing deals and profit shares with partners. So the big profitability swing was really a potent mix of genuine strategic efficiency gains and the significant non-operational accounting item disappearing.
That's the nuanced picture, yes.
Yeah.
It's the difference between fundamental operational improvement, which was definitely there and very strong,
Right.
and a helpful accounting artifact rolling off.
Yeah.
Both played a really significant role in hitting that impressive bottom line number this quarter.
Got it. Okay, let's pivot one last time. Section 3. Let's check the health of the underlying machine. With this high volume, high turnover strategy, how is the actual credit quality holding up? Are they taking on more risk to get this volume?
Actually, the credit quality looks remarkably stable, maybe even slightly better. If you look at 30-plus day delinquencies and you exclude the specific Peloton loan book and those short pay in X loans delinquencies, actually declined 4 basis points compared to last year.
And the sources seem to attribute that improvement at least partly to that big mix shift we keep talking about towards the 0% APR products, which, tend to attract maybe a slightly different lower risk customer profile than traditional interest-bearing loans. Is that right?
That's absolutely the connection they're making, and the data seems to back it up. They're saying recent monthly installment loan groups, or cohorts, are tracking toward ultimate net charge-offs of around 3.5%. It's pretty consistent with their historical performance. Yeah. And those super short-term pay-in-4 loans, they're tracking towards loss rates under 1% of GMV.
So yeah, stable credit performance seems to be underpinning their ability to execute this whole aggressive funding and sales strategy. You need that stability.
Okay, and speaking of funding, the capacity picture looks huge now. Their total funding capacity is up to $26.6 billion, and the company estimates that can support over $60 billion in annual GMV. I mean, that's just massive runaway for more growth if they want it. Yeah, their ABS strategy, in particular, seems to be hitting peak efficiency. They closed that AFRM 2025-3 deal, their biggest ABS issuance ever, $1.1 billion. But crucially, it came with the lowest weighted average yield, the cheapest cost since fiscal 22. Shows they have great access to relatively cheap debt capital right now, and maybe even more importantly for stability, it was their first ABS deal structured with a 3-year revolving period. That adds predictability, reduces the pressure of constantly having to refinance short-term debt.
And the forward flow partnerships, selling loans directly to institutions, that keeps growing too. Added another $500 million in capacity by expanding deals with insurers and bringing on a new asset manager partner. It really does seem like everything is pointing towards a machine optimized for capital efficiency and locking in low funding costs.
And you see it on their balance sheet, too. Their net cash position grew by $196 million over the year, up to $1.1 billion. The board even felt comfortable enough to authorize buying back up to $200 million of their own outstanding convertible debt. So they're not just running the lending model efficiently, they're actively managing their liquidity and, thinking about shareholder value, too.
Okay, so let's try and bring this all together. The core insight for you, the listener, from this deep dive. That huge $196 million profit swing, it wasn't magic. It was a really systematic pivot in strategy. They are shifting hard towards using those strong partnerships to sell off loans quickly, efficiently. That drives fee-based income, the gain on sale, the servicing revenue. Combine that with falling funding costs, improving credit losses, and yeah, that helpful accounting cleanup. And that's what fuels the massive operating income swing, even while the overall revenue percentage of GMV drifts down a bit because they're intentionally pushing those high-volume, lower-yield 0% APR products to win customers.
Exactly. And you can see how this current execution feeds directly into their pretty aggressive forward guidance. They're projecting GMV to go over $47.5 billion for the full fiscal year 26. And they're targeting an operating margin over 7.5%. They clearly believe this model, high volume, fast funding, selling assets, managing them for others, can keep delivering strong results.
Which brings us neatly to our final provocative thought for you today. The sources we looked at clearly indicate they expect that mix of 0% APR GMV to keep increasing. And at the same time, the forecast is for short-term benchmark interest rates to maybe decline modestly over the next year or so. So you've got this highly successful model now, built on efficiently originating and then selling off these low-risk, zero-interest products, and it's being fueled by increasingly cheap capital. So the question to chew on is this. If funding costs keep falling, maybe even just stay low, while consumer hunger for these zero-interest deals keeps accelerating. What does that really mean for credit competition across the entire buy now, pay later sector and maybe even beyond? Is this kind of business model inherently optimized to just dominate when interest rates are soft or low? And maybe more broadly, what happens to overall market stability when capital becomes almost too easy to get, especially for originating consumer credit? Something to think about.